Howdy, Jacob here. Today we're looking at Dynatrace Holdings, 15.1 billion market cap, a billion less enterprise value, a lot of net cash. We're looking like software industry, multi-cloud environment globally, founded in 2005, less than 20 years old, and revenue has been very impressive. Last 5 years, the lowest year-over-year revenue growth is this year at 23.5%. Operating margin immense at 81%. Still trying to find a lot of bottom line hits, but right now 8 to 15% for the last 4 years, not bad. Still trying to find that return on invested capital again. If your bottom line's not hit very well, then obviously it's not going to hit your return on invested capital since it's the uh, net operating cash over the um, your assets or your invested capital amount, depending on if you're looking at ROA or ROIC. And so if you're still reinvesting a whole lot, you're taking away a lot of money today that's going into the future. But again, it's going to dampen your return on invested capital immediately. So what we do see here is over 20% of revenue is being invested in R&D, which again is isn't it? It's an expense today, but it is hopefully going to create more money down the line. And so if they are very good with their R&D spend, this could be very advantageous and keep their growth rate immensely high for the future. But it is good to see that they are starting to make some money on the net income side. As for free cash flow, they are gushing out cash, also helps stock-based compensation of $200 million a year. But form of capital allocation, mostly debt reduction from 2019 or 2020 to 2023. More recently, we're looking at acquisitions and reinvestment. Their balance sheet has over 800 million in cash-like products, no short-term, no long-term debt. So again, very comfortable with the balance sheet like that. And I think I'm ready to make some assumptions here. On the revenue growth side, I always am skeptical about keeping 20% growth rates. So for me, I do like to dampen that a bit, but even 15% a year for a 7-year period is immense growth. I do think they're able to increase their margins a bit due to how much they're spending on R&D, maybe 20 and 25%, because they have got those free cash flow margins before. So I do think that's still reasonable. And then 1% of shares for them is about 150 million, which if you offset their common stock share repurchases with all their options of stock-based compensation becoming shares, that's about 1%. And a PE with 15% growth, I mean, they're still a smaller company from a revenue standpoint. Maybe a 25 PE is reasonable. Still looking for that 15% return. Whoa, not that. All right. So we're saying with these current assumptions, the business needs to fall. The business's stock price needs to fall 52%, about in half, before you get the return we're looking for here. So this is again one of those businesses that has a lot of growth, I think, ahead of them. And when you have a lot of growth, you can overpay a little bit. Obviously, everything is still the present, or most investments are still the present value of future cash flow. But if you overpay for a business that's growing like crazy, 15, 20, 25% above the normal discount rate, you can likely pay a little bit above and it's still going to turn into a great investment. And so keep that in mind. But for me right now, it's still going to have to, even with some fairly aggressive, not crazy aggressive, since they've been growing over 20% a year the last 6 years. But again, the future's unknown. So be a little bit conservative. And for me right now, I'm going to be waiting a little bit longer. Thank you. Hope you enjoy the video.